Hi, this is Crypto Arcade and welcome back. This video we are going to talk about moving averages. We're going to talk about what they are used for and how to read them. So moving averages are an indicator that can be applied to your chart. Once it appears on your chart, it will look something like this blue line. It will wave up and down, price will cross over the blue line, and you can apply as many moving averages as you want to your chart. So basically it's these lines that get applied to your chart. So what's the big deal with them? Well, first of all, let's talk about what they are, and then it'll make more sense as to why people love them. They're probably one of the most popular indicators that traders will add to their charts. So here we are taking a look at a 50-period simple moving average. And basically what that means, so I move over here to the current price. Okay, so this is a daily chart on Bitcoin, and right now it is showing the 50-period moving average is at 54,077. Now you can see that number right here. Okay, so you'll notice when I move my mouse, that number changes because it's figuring out what that calculation is at each of these data points on the chart. And so when I go to the farthest right point on the chart, it shows this 54,000 figure. Now, what that represents is the last 50 periods on the chart. So this is a daily chart. So for the last 50 days, it has taken all of the closing prices, averaged them together, or added them up, divided by 50. So basically it's an average of the previous 50 periods. And right now it's showing that average is 54,077. Now tomorrow, when the new price action is taking place, that number is going to be a little bit different because you're going to be rolling off one of those numbers and adding another number to it. So it's going to be slightly different. So that's the 50-period moving average. It's basically an average over the past 50 periods. Now we can change that. We can make it, a whole host of things. I mean, we can come out here and I can make it a 35. And when I make it a 35, things change. So I'm going to move it back to 50 for a moment. And this is what's called the simple moving average. Now there's another moving average. There's actually lots and lots of different moving averages. There's probably dozens of them. And the second most popular one is called an exponential moving average. Basically, what traders decided is, or when they developed the exponential moving average, what they realized is that, the signals generated off of the simple moving average do not appear to be very timely. And so they wanted the moving average to be more sensitive to the price action taking place. That's where they came up with the exponential moving average. And so here we're taking a look at the orange line is the 50-period exponential moving average. So it takes the same 50 periods as before, but it weights them a little bit differently. It weights the most recent price action heavier than towards the end, so like at period 49 and period 50. So the most recent price action is weighted heavier. And so as a result, what you'll see is that the orange line tends to react quicker to price. So you'll notice here that the orange line, when we came up here into this high, notice how the orange line did not go as high as the blue line, and it started to turn lower well before the blue line did. And that's because as this downtrend was starting to take force, the exponential moving average was giving more weight to the most recent price action. And so those candles that were heading into this downtrend had more weight than the candles back here towards the left. And even down here towards the bottom, notice that when this bottomed out, the orange line reacted quicker than the blue line. The orange line did not make it as low and started to turn higher before the blue line did. And so that's the benefit of the exponential moving average, is that it tends to be more sensitive to the price's behavior. All right, so there's your two most popular ones, the simple moving average, the exponential moving average, and basically it's taking the last X periods. In this case, I'm using 50 as an example, the past 50 periods, and it's rolling some kind of average over that. Now we can do other things to manipulate these moving averages. I mentioned this a moment ago, where we can change the period to, the period from like 50. This light blue line is a 200. So you can see the difference between a 50 simple and a 200 simple. Notice that these lines basically do completely different things. All right, so that's an overview of what the moving averages are. Now that we've got these on our charts, what do they mean? Like, how am I going to use these? And one of the biggest reasons why it is one of the most popular indicators that traders add to the chart is because they are versatile. There are several different uses that you can use for these moving averages. So let me turn that off here real quick. One of the uses is what we had just talked about a moment ago in support and resistance. Okay, so let me come over here and grab my highlighter. You'll notice right here, prices came down, touched the moving average, and rebounded higher. This moving average was acting like support. And then even after it started to break down below this moving average then started to act like resistance. Okay, and then here it is, it's acting like support again. So that is a common way of using moving averages, especially the longer term moving averages. A longer term might be a 50-day moving average or a 200-day moving average. Now there's a couple of different, you could use these on all time frames. So if I change this time frame over to a 4-hour chart, for example, the moving average changes because the last 50 4-hour candles is going to be different than the last 50 daily candles. Okay, so, but it's the same type of concept that applies on a daily chart versus a 4-hour chart versus a 5-minute chart. So one of the common uses is support and resistance. And again, you can see here a little bit of support taking place at the moving average. Now, in order for support and resistance, or for the moving average to be effective as support and resistance, we need to be in a strong trending market. And that's where crypto really helps out. Crypto tends to be in some type of strong trend, either to the upside or to the downside. So when you get strong trends like this, then you can use the moving average as a tool for support and resistance. However, if I scroll down to a 1-hour chart, the trends on the 1-hour chart are not as clear and not as heavy as they are on the longer term time frame. So you notice here, basically the price action that we're seeing, prices have been moving sideways. And notice that prices have been whipsawing up and down between the moving average, above the moving average, below the moving average, a lot of cross up, cross down. And so this is where using a moving average as support and resistance is not helpful. When you get sideways trends, range bound type of markets, moving averages are not going to be helpful in determining support and resistance. It's during instances like these where you could go out and take a page out of our previous lessons on support and resistance, and you could look at this and be like, all right, it looks like we've got some horizontal, like when you get a range going, horizontal support and resistance tends to be an effective way of identifying levels to buy and sell at. So here's two different levels of support and resistance that are horizontal, and those are easy to find in a sideways range-bound type of market. So the moving average of support and resistance is one way that traders use moving averages. Another way that traders will use moving averages, and I'm going to try to get rid of a few of these things here. Another way that traders can use moving averages is to determine the trend direction. So basically, when the price is above the moving average, then the trend is said to be up, and you want to look for buying opportunities. If price is below the moving average, then the trend is said to be down, and you want to look for selling opportunities. And so a way that a trader might do this is whenever price crosses above the moving average, then this would have created a buy signal right here. So this would have been a buy signal. Okay, and we did not get a cross down until right here. So this would have been a sell signal. Okay, now that sell signal would not have lasted very long. We would have came back up and traded sideways and would have been whipsawed back and forth a little bit. But that's how you could use it as a trend direction. And to even take this another step further is you can come out and we could add two moving averages. This is another popular tool, popular way that traders will use moving averages, is they'll use two moving averages and they'll use the longer moving average in case this one that moves a little bit slower, and they'll say that's the trend direction. And when the shorter moving average crosses above the longer moving average, they'll use this as a signal to buy. So right here, we get a cross up. And so let's say this is a buy signal. And then right here is a cross down. And so they'll say this is a sell signal. Okay. So there's a couple different ways to use it. Again, trending markets is when moving averages work the best. If the market is not trending and if it's moving sideways, then stand aside from using moving averages. You're going to want to look for your horizontal levels of support and resistance to help identify when to get into and when to get out of trades. So in the next video, we're going to expand on moving averages, and there's another indicator that we're going to add to the charts. And the indicator uses moving averages, and it is a very versatile indicator as well that can generate a lot of signals and really can tell us a lot about what's going on in the market. So we'll be talking about that. We will see you in the next video. Bye now.